Hey, soldiers, we just saw the big national banks make a move that could indicate we'll see the closure of some regional banks next year. I want you to write in the comments, are you confident in the status and staying power of your bank? Let me know if you bank with a large national or a regional or a community bank or credit union. Let me know if you're confident in your money in that institution. Look, here's the deal. We've got a lot of pressures for the banks. We just saw these big boys do something that is going to accelerate in terms of them losing money. We just saw the biggest banks write down bad debt to the tune of billions of dollars. The largest U.S. banks are reportedly bracing themselves for a surge in bad debt write-offs, the highest since the early days of the illness, we'll say. We don't want to trigger any algorithmic restrictions. JP Morgan Chase, Citigroup, Wells Fargo, and Bank of America are expected to report a combined $5.3 billion in net charge-offs for the third quarter, more than double the figure from a year earlier. What are these charge-offs? Well, debt that they can't recoup. They've extended loans for, whatever reason, be they credit cards, be they commercial real estate, what have you, and they're just not able to collect. Why? Because in terms of commercial real estate, take a look at this chart. It goes back to 2008. We can see that the delinquencies on payments, mortgage payments for commercial real estate, those delinquencies are rising. Why is that happening? Well, we all know, because we're in an era now where companies have figured out they don't necessarily need a large real estate footprint. They can actually utilize technology and have their forces, their employees, working from home or working remotely. All right. The technology is there. Why not use it? The paradigm has shifted, and we see a corresponding increase in the loss of popularity of commercial real estate. Now, all this is occurring against the backdrop of a strong possibility for a recession and economic downturn if we're not already in one. We can't trust the numbers coming out of this government. And we also have rising interest rates. So when we look at these factors and then we add in the fact that credit card delinquency rates are going up because consumers maxed out, you can see that the banks are getting pressure from two very large sources of income. Credit cards, having to write down some of this debt, commercial loans on real estate. Now, one bright spot, and I hope it stays this way, is the residential mortgage loans. Those don't seem to be increasing in terms of the amount of delinquencies. So folk are pulling back. They're saying, look, here, I got a home. I got to keep this roof over my head. So I might not be able to pay that credit card because those interest rates have gone up to the 24% range. I'm maxed out. All right. And we've explained to you the reasons for the commercial delinquencies. So these banks, the larger banks, are feeling pressure to the tune of $5.3 billion in one quarter, twice as much as the same quarter last year. So think about the amount of pressure that would put on smaller banks like the regionals. And you got to understand also, the regional banks are really exposed to commercial real estate. You drive around your town and you see it everywhere on construction projects. This construction project sponsored by or brought to you by, and it'll have a regional bank's name there. Okay, I never see JP Morgan or Bank of America. I always see a regional or community bank. A lesser known factor that is impacting the bank's profitability is net interest income. Now, net interest income is simply the difference between the interest earned on loans and the interest paid on deposits. So what we're seeing is a rising cost just to have those deposits, and that's impacting profitability and revenue as well. Now, of course, the larger banks are going to be able to absorb that a lot easier than the regional banks will, putting more pressure on both sectors of that industry, but really, forcing the regionals to maybe think twice in terms of how much interest they're going to demand from folks who are seeking loans, what their credit scores need to look like. So all of these things will conspire to restrict lending by the regional banks. Not to be outdone, the United States banking regulators have mandated that banks keep a certain amount of cash on hand. That becomes more difficult to do in tougher economic circumstances. So that's money that they really can't put out there and play around with because the United States government demands that it serve as reserves. So we will continue to watch the vacancy rates with commercial real estate. We need to watch it as, of course, a nation, but also in regions as well, because again, real estate is a hyper-local economic phenomenon. And just because something's doing gangbusters over here in this area of this state does not mean that one state over, or even in many cases, a few blocks over or a county over. It's not just a different situation altogether. So that's one thing we need to watch. Also, the credit card delinquency rates. And right now, as I said, residential real estate mortgages are not seeing big issues with delinquencies, but it's something we need to keep an eye on. And we certainly will here at Soldiers of Finance. Guys, I'll talk to you soon.